Good morning and welcome to this Monday, May 11th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Wow. Well, we finished, on Friday, not too bad. Market had another good week. Those of you who are Earnings Beats members, we had a really good week with our portfolios. All of that's been updated on the website. We had a great webinar on Saturday. And those of you who are Earnings Beats Digest members, I believe the recording is going out. But yeah, it was a great session on Saturday. We had Grayson Rose, who's the Vice President of Operations over at stockcharts.com. Grayson and I worked together a lot when I was at Stock Charts. Younger fella, but really sharp. So he was on, talked a little bit about organizing your Stock Charts account. Then he and I had a session where we went over some picks that we had made back at the beginning of April on a TV show over at Stock Charts called The Pitch. And those stocks, both of us averaged about 34 or 35% gain on those 5 stocks since April 1st. So I challenged Grayson to give me 5 more, and I also gave 5. And so all of that was part of the webinar on Saturday. I hope you made it. If you didn't, check out the video, the recording. And then we also had Bill Shelby in, and Bill is the lead software engineer at Stock Charts. He's responsible for the scan engine. And so he was on talking a lot about the scan engine, which was really cool as well. So he was mostly focused towards some of the basics, just because I think if he went into the details of the, really difficult scan engine techniques and some of the things that are a little bit more complex, everyone's eyes probably would have been rolling back in the back of their head, and I know mine would have been. But yeah, Bill is incredibly sharp. And so he went through the scans, and then he also worked with me a little bit on the accumulation distribution chart lists and how we could scan against those, some of the concepts, because I was having problems figuring out, okay, how do you scan against it? And Bill kind of backed me up and said, hey, it's kind of tough. It's not something, it's because you don't have a scale on the right side of the AD. And, it started back at some point, many years ago, and it's just this arbitrary number that just keeps going up and down. But he had some interesting insights into it. So again, check that out. I went through a couple of areas creating the portfolios. If you haven't, if you are new to Earnings Beats, the model portfolio is up over 62% in 18 months, just under 18 months. Or, yeah, it was November of 2018, so it's just under 18 months now. 62%, that's through the trade war, through a lot of volatility, of course, the pandemic. 62% higher in 18 months. S&P 500, I think, is up 8% in that same time frame. So anyway, I had a session where I went through and talked about how I create portfolios to try to beat the S&P 500. And then also had a session talking about trading short squeeze opportunities. And we have a new chart list now for our members who are also members at Stock Charts. Actually, you don't have to be a member at Stock Charts to see the chart lists. You can go through them one chart at a time, but in order to download them and to make it easier to organize yourself and prepare to trade them, I think you need to have an account over at Stock Charts, and they have a 30-day free trial, so check that out. But anyway, we had a great day on Saturday. I hope you all made it. If you didn't, please try to check out that recording. If you have any questions or you're wondering how you can get a copy if you don't know, send us an email at support@earningsbeats.com, and we'll make sure we can get you a copy of that recording. All right, let's talk a little bit about Friday. Actually, before we get into Friday, I do want to mention one other thing. I want to just make sure that everyone is aware. We are having an extended 2-week spring special over at Earnings Beats. So if you are new, this is a great time to join. You can go through this green button here and join today. You click on that, it'll take you into just a page that describes all of our services. And when you subscribe, it's fully refundable, $7 for 30 days. So you get charged $7, but then you'll get it back in 5 to 10 days. So technically, it's a free 30-day trial. And again, like I said, Stock Charts has the same thing. So if you really want to check out what we do, it would behoove you to make sure you're a Stock Charts member. Once you're in your Stock Charts account, if you are a member at Earnings Beats, you just go into this area over here on the left side of our navigational panel under members, go to chart lists. We've got a number of chart lists. You literally can just click on these and just download them into your account. You'll need the password that we give you here. So you click on this, it takes you to over to Stock Charts, and they will ask you for this password. And so type in the password, and then you can download directly into your account. Very, very cool. So strong earnings chart list. We have a relative strength industry group chart list, which is available to all of our annual members. This chart list, once you have it, you have it. It doesn't change. Strong earnings chart list will rotate. These strong AD chart list, the weak AD chart list rotates. The portfolios rotate every quarter. The new short squeeze chart list, which we gave away or said it was available on Saturday, this is would rotate. All of our max pains each month, they rotate. The pandemic stocks, well, that should still be good. And then go through and occasionally we'll update these quarterly earnings, bullish and bearish chart lists. But I mean, you can see a lot of work put together that literally you can just download right into your account. But the thing I wanted to mention with this relative strength industry group chart list is that it's a 104 chart list. It's set up for a 3-year weekly. Once you have it, industry groups don't change. So there is nothing to update here. So that's why we would like for you to have an annual membership before we send this out, simply because once you have it in your account, you have it. It's good to go. And I'm going to go over some of the industry groups here just a couple minutes here in today's show. So we'll get into that in just a minute. But anyway, you can go in here and download like that short squeeze chart list, click on it and type in your password. And I think there were, I don't know, 140 maybe, 140 charts. The ones with the highest probability of short squeezes, these are companies that have huge percentage short of float numbers, or just have so many shares. When you take the number of shares times the stock price, that dollar amount, that's the dollar amount of shares short. Tesla's over $15 billion of shares short. So if Tesla gets rolling again and breaks out, you've got a lot of folks out there that they've got to make some big decisions, because when you're shorting, your risk is unlimited. Prices keep going up. You just lose more and more and more money until you don't have any. So you got to be careful shorting. And a lot of folks, they dig their heels in and say, hey, Tesla shouldn't have this kind of market cap, but if they keep growing their earnings the way they are, I would be careful with that short position. Anyhow, so I just wanted to point that out. Also, if you are over at Earnings Beats, here's the special I was talking about. So it's a spring special. Normally we charge $697 for a year, and normally we charge $97 for a month. So obviously signing up for the year saves a lot of money. Well, during the spring special, we're adding another 2 months. So you get 14 months for $697. That's going to last for almost 2 more weeks. So if you want to try our service for free, you've got a couple weeks to decide if this makes sense for you. So this is a great time to try out our service. And you can see all of the different things that we offer. And that's not everything. That's just a highlight of a lot of things that we offer. But anyway, just go to earningsbeats.com and click on the webinar special, and that'll bring you to this page. You can check it out. All right, let's get into what happened on Friday. The Dow Jones Industrial Average up 455 points, up 2%. S&P had a nice day. NASDAQ had a nice day. Mid caps and small caps, look at the performance there. 3.46%, over 4% on the small cap. The mid caps and small caps, which have been underperforming quite a bit for quite a while, definitely outperformed on Friday, as did most everything else. Look at the sectors that were leading: energy, industrials, materials. Those 3 groups have not been leaders. Staples were leaders in April, kind of have relaxed that over the past few weeks. The worst performing group on Friday was healthcare, which has been one of the best performers over the past few months. I think that money will rotate back into healthcare at some point, but we're still getting this rotation. A lot of beaten down groups were aided on Friday. And for me, with all of the solid groups in terms of sectors and industry groups that have been breaking out or certainly getting close to those February highs, those have been looking good technically for quite some time now. But we're starting to see some of these other areas. I mean, look at energy, which has been horrible. It's bounced back. It's putting in higher highs. It challenged those highs on Friday. We'll see what happens today. Futures are down, by the way, this morning. They were down quite a bit last time I looked, maybe 250 on the Dow, but it's been a little while. Let me give you that before we go any further. 276 right now on the Dow. But one of the things we've seen over the past couple months is gap downs followed by more buying. So that'll be something I'll be watching today to see whether or not we just follow that same pattern or whether or not we actually do sell off and fear starts to pick back up again. But when you look at the sectors coming across here, you can see energy starting to strengthen. Industrials, while they've not been good, and in fact, they've been pretty poor, but notice they went through the 20-day, they've pulled back, they've held this level around 60. I'd be watching, 59.5 to 60 on the industrials. As long as we hold that and consolidate the recent gains, ultimately a breakout above 66 would be very bullish. If you start getting more and more sectors that are following this bullish theme and starting to act more bullishly, holding moving averages that are rising and bouncing off of them, those are signs of a bull market, not a bear market. Bear markets, you come up these moving averages and you roll over, or you have a quick little breakout and then, to try and draw some technical buyers in, and then you get the collapse back down. We have not seen that. As long as the overall market continues to trend above the 20-day moving average, I wouldn't be thinking anything but bull market. I mean, you've got PPOs that are above zero almost everywhere. Staples are right around the center, zero line. Industrials, even right around the zero line, as weak as they've been. As long as you've got many of these groups on buy signals, I would not be thinking bear. If you break down, yeah, you got a different story. We got to reevaluate. But don't try to trade what isn't there. Trade what is there. And right now, we've got bull market scenarios lined up everywhere, just about everywhere. Airlines would certainly be one exception. All right, 10-year Treasury yield. No economic reports out today, so they're not going to have any significant influence there. But what you can see now is we are trying for the third consecutive day to close above the 20-day moving average. The last time we had any kind of movement above the 20-day was back in mid-March. One day up. Yes, we closed above it 2 days in a row, but that day was not good. I mean, when the yield went down, that meant money was going back into treasuries. And as we kept dropping in the yield, money continued pouring into treasuries. Now, I have pointed out on many occasions, so I'll point it out again, a lot of hollow candles here in the yield, which means a lot of filled candles in treasury prices, the treasuries themselves. And that means that there's been a lot of fear at the open, just like today, we're getting a move down at the open, but then we reverse. So treasury prices go up at the open, and then you've got a lot of professionals selling those treasuries. Yield's going the opposite direction. So yield a lot of times is going down, but you see a lot of hollow candles. So that's just the opposite. It moves the opposite of treasury prices. But the fact now that we're trying to close for a third day of the last four above the 20-day, the 20-day is stabilized. It was clearly moving lower and we were trending below it. This is a really good development, I think, in the market, because as the yield moves up, if we start to see the 20 turn higher and the yield stays above it and we start trending higher, as the yield goes higher, money's coming out of treasuries. That's just more money available to go into equities. And we have seen a ton of money move into treasuries. So if that money starts to rotate, we could have a lot further to go in this equity rally than most people think. I'm still on record. I've pretty much stood by this call that I believe we are in a secular bull market, even at the depths of the low. In the stock market back in March, I still felt it was like 1987. It was a crash, but it's something that was going to recover. Yes, the coronavirus is a real health scare. I'm not trying to diminish that at all, but it's, we need a bridge we had a very strong economy before this hit. And now it hits. We're already seeing many areas of the market still doing well, that the stay-at-home social distancing has actually helped many businesses. So yes, for all the, there are a bunch of airlines, cruise lines, and so forth that are getting hit to the downside. But for every one of those companies to the downside, we have other companies to the upside that are killing it in this environment. Many stocks last week up 10, 15, 20, 30% last week. So I would try not to get overly bearish. I keep hearing and reading articles that we're going to roll over at this level. We're going to roll over at this level. We're going to roll over at this level. Hey, I said it at one point on the S&P 500, that first move up right here, I thought this could be definitely a move down for a retest at least. But as soon as we went up, pulled back, and went through that 20-day moving average, look at the rest has been history so far. We haven't had a single close on the S&P below the 20-day since we made this move through the 20 and through this price resistance. So be careful, thinking too many bearish things right now. All right, let's keep moving here. Dollar's just been kind of going sideways. I've been watching it, and one of the reasons I've been watching it is that it's in a long-term uptrend, and as long as it stays in that, I want to stay away from energy and I want to stay away from materials. Why? Well, if I show you the chart here, long-term of the dollar, here was the low in 2011. And if you connect these, I'll annotate this for you. So if we just connect these lows, basically what you see is a really nice trend line. I think it'd be hard pressed to say that the dollar's in anything but a longer term uptrend right now. So you connect these lows and they're rising. As long as we stay above that level, I would treat this market as though we're, the areas of the market that are going to benefit from a stronger dollar or are going to be harmed by a stronger dollar. I think you have to continue to monitor. And those two of the areas that get hurt by a stronger dollar, you've got materials and you've got energy. And you can see since this all started, I think it's pretty clear. Can't really draw a trend line there, but maybe down like that. But this is XLB relative to the S&P 500. It's been going down now for almost 9 years. Actually, it's been about 9 years. Energy actually topped all the way back here in 2008, but pretty close to a double top like materials. So I'm going to say 2011 is kind of when we rolled over and started moving lower. If these two groups have been underperforming the S&P 500 for 9 years, and your goal is to outperform the S&P 500, it's going to be hard to do it if you're investing in material stocks and energy stocks. You might have a few, I'm sure there are plenty of outliers in those areas that you could invest in and make some money, beat the S&P, but it's much harder. I mean, if you want to try to beat the S&P and you say, well, should I invest in something like materials or technology? How about software? Software has been going up versus the S&P 500 for years. You can almost throw a dart at a software stock and outperform the S&P 500. You're not going to do that in materials and energy, so keep that in mind. So the big question I have right now is what's going to happen to the dollar? We're kind of going through this sideways action. Looking at the long-term chart, I would say this recent low down here, just below 95, that's about where the trend line comes in. If you start trading below 94.5, 94 on the dollar, that could change the landscape for materials and energy. But until then, for the most part, and I've been doing this for 8 years, 9 years, I just ignore the group. I just don't trade it. Here's the CRB. So this is the, an index tracks mostly commodity. Well, it does track commodities. But look at the CRB coming down. Now we've seen some recent strength, but check out the low here. So as we were going down, we had 3 different lows with positive divergences in place. First were these two. You can see that the PPO is a little bit higher. Tried to strengthen, failed. There's your failure at the 20-day with that shooting star, and then right back down. That's what we typically see. By the way, we didn't see that on the S&P weekly chart. We didn't see that follow through, and I'll show you that in just a minute. But here you can see we went back down to another low, and we still have a positive divergence in play. And now we've gotten through the 20. A lot of times these positive divergences will play out to the 50, and you'll see the PPO get back to the center line, and then from there, a lot of times you'll roll right back over again. I wouldn't be overly bullish, the CRB, unless the dollar were to break down and we were to make a move through about 131, 132. So still a little bit of work to do on this index before I would get excited or even reevaluate my stance there. All right, let's move on. I wanted to go through some areas of the market. Actually, I just mentioned the S&P, that weekly chart. Let me do that before I forget. So I want to show you this candlestick. I had pointed it out to EB members in the portfolio report, I think last Sunday. But here it was. You see that move up to the 20-day? Just look, the same thing we just looked at, CRB. You move down, big move down, you come back up, you test that 20, you put in a shooting star candle, which is a long tail. So intra-week, we were above the 20-week moving average, looking really bullish. And then the carpet gets pulled out from under you. You come back down, close near the low. So it's almost like this inverted, like an upside down hammer. Hammers off a downtrend are bullish. Shooting stars off an uptrend are typically bearish. And yet look at the market come right back. That's, if we're in a bear market, we wouldn't see that. S&P 500 would print that shooting star candle. Next thing you know, we would be down, and it probably would be down fast, just like the CRB did. And then maybe at some point we come back down here and set a positive divergence, and then maybe, start to strengthen. But this is looking more and more to me like a V bottom. And I didn't think we'd have a V bottom, but that's what it's looking like. Till we get some kind of confirmation, moves back below some key moving averages on our major indices and sectors, industry groups, I would stick with the bullish theme. All right, industry groups and sectors. So what's been working? And this is where, I said I don't trade energy and materials. So what do I trade? Well, I trade I'm a momentum trader. I'm trading what's working to the upside. I'm not going to try and time bottoms. So when you look at the sectors, it's pretty easy. You got technology. Oh, by the way, let me go back here. So this is a 3-year relative chart weekly. So this is technology versus the S&P 500. So it's not like technology's been going up since the beginning of 2019. I mean, we know technology got hit down here in the pandemic. This is the absolute chart. But even when it was going down, it was going down less than the S&P 500. And that's why the relative chart keeps going higher. So technology looks good. Consumer discretionary has come roaring back. A number of areas in consumer discretionary really picked up. Communication services has broken out. I'll show you internet in just a minute. Very strong area. Industrials, not so much. Financials, definitely not. Healthcare, yep, been very strong, pulling back on a relative basis, but we're still well above the 20, which is well above the 50. PPO's very high in positive territory. Just seeing a little profit taking, but healthcare remains strong. Staples is, I don't quite know how to read this. I think what I'm seeing when I look at this is that the market is not as fearful of the pandemic anymore. I think one of the reasons we had so much strength in staples, we had stocks like Clorox that were going up. Clorox is still going up, by the way, but there are a lot of others that were going up for a couple of reasons. Number one, they weren't being hit as hard by the pandemic. And number two, when the market gets fearful, consumer staples is an area where the market tends to move. So you can see that moving up, moving back down. The rest of them, not so much, not that great. I want to get into some of the industry groups. Go through some of these. I'm going to point out the ones that I really like. So let me start with semiconductors. Look at the semiconductors relative to the S&P. This is a relative chart. It's staying above the 20, which is above the 50, just keeps roaring, broke out to a new high last week. Semiconductors, and then you can go into semiconductors and look for the high scooters. Look for the best of the best. That's how you're going to make money in the market. Are they going to pull back? Yes. In fact, with options expiring this Friday, this could be a tough week or maybe into the early part of next week. But yeah, this is going to be an area you still want to continue to focus on. Software, I mentioned, this thing's they've been going up forever, it seems like, against the S&P. So if you're trying to outperform the S&P 500, you don't own a software stock, it's going to make it a lot harder. Next up, computer hardware, another area of technology, just killing it to the upside, breaking out. I mentioned that the consumer discretionary has been strengthening. Look at toys. Toys in the doldrums throughout much of 2019. Once this pandemic hit, toys is taken off. Got to keep those kids busy at home. Next up in this space, I don't know if you've noticed, home improvements. Home improvement retailers broke out on a relative basis to a new high. You know, at first this was a group that was tortured first half of March, but wow, has this group come roaring back. So got to keep them on your radar. Then we've got specialty retailers breaking out on a relative basis. How about broadline retailers? Another strong group. Autos, and a lot of this is Tesla, but autos strengthening, very strong, pulled back, but has come roaring back. Internet. Remember I said XLC is doing really well? Look at the internet. This is definitely one of the strongest areas in the market right now. One that you might not think would be strong, and not too many are in the industrial area, but truckers broke out to about a, 15, maybe even an 18-month high, relative high. But right at the beginning, you know, this is basically since the pandemic, truckers, very, very strong. In the financials, not too many strong areas, but got to mention this first one, which is financial administration. PayPal, although PayPal kind of might be characterized as software, I still view them as financial administration. But you got a lot of those types of stocks that have been doing really well, breaking out to new high here. Specialty finance, kind of hard to dislike that group. You got companies like MSCI, SPGI in there, been doing extremely well, great reports. Health care providers, nice uptrend. Medical equipment, breaking out, been very strong. Biotechs, one of my favorite areas, absolutely has exploded here in 2020 on a relative basis. And then the last two, not exactly huge fans. I mentioned, you know, I'm not a big fan of materials, but gold mining and miners. I mean, here you can see gold mining absolutely exploded. I think some of this has to do with the fear that's still in the market. That's generally when this group outperforms. The miners, you can see, doing essentially the same thing. So there are 4 areas I wanted to mention, though, that have been improving. So let me see if I can find those on this list for you. First one is the consumer or specialized consumer services. So you got a company like eBay, which is starting to kill it. Look at this group breaking back up above its 20-day. So it's just starting. It's in negative. You know, maybe we see it roll over. So if I was going to go into this area, I would just really make sure I stick with some of the leaders in that area. Home builders. You know, I never quite could understand why the home builders were getting hit as hard. I mean, I know it's hard to buy a house if you can't go in and look at it because, you know, of the stay-at-home restrictions and all. But my gosh, interest rates, you can't get a better interest rate than you're getting out there right now. Home builders bouncing back pretty quickly. So this is a group I think looks much stronger now. Recreational products. Another one, look at it's trying to make a break to about a 15 month high, relative high. Let's see if it can do it. Still got a negative relative PPO, but it's strengthening. This is a group that certainly has come to life here over the past 5-6 weeks. And then the last one I have that has begun to strengthen quite a bit is renewable energy. So renewable energy, the last 2 months, really strengthening, moving back above its 20-week moving average. That's the first time in about 7 or 8 months. So renewable energy, I think, is beginning to strengthen. So anyway, I just wanted to point all those out. Earnings, let's get into running out of time here. I want to go through a couple of these earnings reports. Marriott reported, not a good report at all, as you might expect, and the stock is down more than 3% today. What else do we have? ZBH, which is Zimmer Biomet. They actually beat $1.70 versus $1.53. Stock up almost 1%. How about Cardinal Health? Really good report here. 162 versus 143 on the bottom line. Nice reaction, trying to break above this recent high here around 53. Looks to be opening maybe around 53 3/4. Nice breakout here on CAH, it looks like. UAA. This is Under Armour. Down almost 10% pre-market. It was a bad report. 34-cent loss versus 19-cent expected. Store closures, can't sell your goods when stores are closed. So the stock getting hit pretty hard. AutoNation, last one I'll point out here. AutoNation having a really good session pre-market. Well, let me just go ahead and show you this chart because they were up about 9%, I think. Opened up 9%. So nice breakout here. Now, I wouldn't chase, but this is a stock that I think looks pretty good. You get a pullback, later in the day, back, close to the open, which is possible. I'd have it on my radar. AutoNation, 91 cents on bottom line versus 70. All right, last thing I want to go over is the 3 you must see. Then we'll wrap this thing up. So let's take a look at FLT. FLT, Fleet Core, right here. It's not showing anything trading so far today, but I didn't like that reversing candle. If I get a stock, even if it's in a nice uptrend, if I get a reversing candle like that, bearish engulfing with increasing volume, I normally would expect to pull back close to maybe that 230 level at least to test that 20-day moving average. So we'll see there. Another stock I wanted to just show you, OLED, also false breakout. It's starting to strengthen, so that's good. It's kind of a mixed picture here. PPO is good. Accumulation distribution, kind of drifting lower while price goes higher. Maybe be a little careful with this one, but if it goes down, it goes below the 20-day and then comes back up and holds it, that might be a signal to consider a position in OLED if you like the stock. And then the last one I have for today is True, which is TrueCar. This was a smaller stock, but I saw it. I saw the AD line building, got the PPO now, is in positive territory. The stock's run from 225 to 350 in about 7 days, and then took a pretty big hit on Friday. I'd kind of watch that 20-day moving average. If you're somebody who likes to take risks, this isn't for those who can't sleep at night because of their stocks. If that's the case, then pay no attention, mute me right now. But if you're somebody that does like a lot of risk and you think, if getting into a stock around 260 with the possibility of it going back to 350 is appealing to you, then consider it. Just also understand that this stock's been in a downtrend. You've seen multiple gaps all over the place, huge gap down here, huge gap down here. So that's the risk you're taking when you get into these smaller stocks. But it's definitely showing some strength. Volume's been picking up, and a pullback down to that 20-day moving average would be interesting. All right, quick update of the market. We ran just a little bit over today, but let me see where we are. Yeah, Dow's already, off of those earlier poor futures, down 216. Still starting off a Monday week. Always respect Mondays, but overall, market's been very strong. I'd be hesitant to think too many bearish things when the market goes down a little bit. The market's gone up a lot. Let's give it a little room to the downside. If we start losing 20-day moving averages, that's when we have a lot more potential risk to the downside. I would stick with the bullish theme for now. Everybody have a great day. Happy trading. Be back tomorrow at Stock Charts TV. Take care, everybody.